Thank you for being here with us. First and foremost, I must apologize that we're starting a little later than we intended. This is a new market for us, and we're still learning. So welcome. It's good to have you here. We thank you for taking time out of your busy schedules. We understand that everyone has their busy and important things to get to, so we quite appreciate you turning up for us. My name is Wonu Kunle Bello, and I'm the country manager for Agusto and Co Limited in Ghana. And it is my honor to welcome you here. Given that we spent so much time already, I'll just proceed to introduce our keynote speaker for today so that we can kick off the event. All right, so today we have the honor of having in our midst Dr. Kwesi Edwafo Yankee, who will be our keynote speaker for today. Please, can we welcome him to the stage?
Good morning, distinguished ladies and gentlemen, and thank you for being here today. I am really filled with emotions as I look at the name Agusto and Company. A dear friend of mine called Bode Agusto founded this company. Bode and I were friends, or had been friends, for 30 years until he passed. So I am really filled with emotions this morning that a company that he founded, and he had tried to make sure he brings it to his friend's country. Took him such a long time to get here. And I know that he is very happy wherever he is. And we can also assure him that this will be a very successful company from now onwards. And the little that I can do to make sure that this happens, I will try and make sure that it does happen. I welcome you all to today's event. We deeply value your presence and dedication to these crucial issues, which are fundamentally aimed at deepening the domestic debt capital market and fostering sustainable growth in Ghana. Domestic debt capital markets have an important role to play in mobilizing private capital in finance development in a country. These markets are also a vital source of stable, sustainable finance and underpin a private sector associated with employment is still relatively small compared to other emerging markets. Specifically, the establishment of the Ghana Fixed Income Market platform, launched in 2015 to facilitate the secondary trading of all fixed income securities in Ghana, has helped to improve fixed income liquidity, albeit marginally. However, the inefficiencies of a nascent capital market, illiquidity, elevated transaction costs, etc., still remain. These inefficiencies limit price discovery and hamper investor ability to diversify their risk. As of May 2024, government debt securities made up 95% of the market, while the corporate sub-segment made up 5%. Speaking largely to the underdevelopment of our debt capital markets, the above notwithstanding, the debt capital market in Ghana has a lot of potential, and we have seen increasing issuances on the market with Kasaprekon PLC, a 600 million note being one of the most recent in the market. Given the current elevated borrowing costs and difficulty in assessing commercial loans, especially the DDEP, there is no better time to deepen the market by diversifying the funding sources available to companies in the real and financial sectors alike. Credit ratings have been known to provide much needed transparency and access to long-term and affordable financing of all, which are critical to sustain economic growth and development in countries. Specifically, credit ratings provide an essential measure of relative credit risk, facilitating the efficient issuance and purchase of bonds and other debt instruments. It is therefore in our interest to advocate for and develop a transparent and contextually relevant credit rating culture. I will stop here and then hand over this to all these speakers that we have selected, who are very well adept at or do have knowledge which they will share with us. And on that note, I would like to end and say thank you very much for your presence and also your support, and wish your continued support for Agusto and company. Thank you very much and welcome and good morning.
Thank you very much, Dr. Yankee. It's an honor to have you here with us. Our next speaker. Our next speaker needs very little introduction in this room. Our next speaker is Mr. Sheyi Kumakpai. Mr. Kumakpai is the Executive Director, Africa Subsidiaries at Access Bank PLC. Prior to his appointment as Executive Director in November 2020, Mr. Kumakpai was the Group Chief Financial Officer of Access Bank PLC, a position he held since 2008. He is a highly accomplished and result-driven professional. He has over 20 years of progressive banking experience spanning finance, strategy, risk management, and treasury. Mr. Kumakpai is an alumnus of Harvard Business School. He holds a master's degree in mechanical engineering from the University of Lagos and a bachelor's degree in agricultural engineering from the University of Ibadan, Nigeria. It is my pleasure to welcome to the stage Mr. Sheyi Kumakpai.
Morning, ladies and gentlemen. Good morning, ladies and gentlemen.
Good morning.
All right. It's my privilege to be here, and I think I've known Agusto and Co for how long? You know, when I used to be CFO, Yinka and Vivian Shobo, I don't know how many of you know Vivian, used to grill me a lot. We used to sit in one small office. The very first time they came, we had only 27 branches, you know, our very first rating. So they were asking us, you know, where are you people going? You want to be top 10 bank? You know, questions. I'm glad that they've now seen the vision. They are also expanding, you know, outside of Nigeria. Congratulations. And I think please let's give them a round of applause. All right, so I've been asked to speak on a topic around, you know, funding in Africa. And I guess for us to grow our economy, right, it needs to be funded. And so I'm going to try to do justice to. Okay, go to the next slide, please. You moved too fast, Chief. Just go on. All right, so in terms of this introduction, banks, as you know, we call us the engine of growth. And really, literally, we transmit government policies. If you look at today, in the largest market in Africa, bank assets is about 55% of nominal GDP. So banks are significant. But for us to be able to do that credit creation, creating velocity of money, we need to fund that. So funding is required. And if we don't fund, if you look at what we do, we lend, because our business is about lending, taking from the deficit sector to the surplus sector. That's how traditional banking is defined. It means you are taking savings and you are creating lending to support growth. So that's what we do. The third thing is that over the last maybe 10 years or 5 years, what we've seen is, or six years, what we've seen is that there's an elevation in the cost of funding. Obviously, what has happened in the macroeconomic shocks, what's happening in the US. I remember maybe 2 years ago, 3 years ago, when we did, you know, when we borrowed dollars, maybe we borrowed dollars at maybe 4%. Now, if you find dollars at 9%, honestly, you will have tried. So we've seen a significant increase in cost. Can you go to the next slide? Don't mind. But what is leading to that is literally about the world economy and how it's affecting Africa. You know, 10 years ago, 15 years ago, we used to say we are insulated from the world, but it's a lie. We are not. We are completely connected to the world. And so anybody tells you, no, this thing that happened in China is not going to affect me. Trust me, it's going to affect you. So if you look at what has happened in the world, growth is a bit, you know, sluggish. Interest rate, thank God, we are starting to see some rate cuts in the US. The US hasn't happened yet, but I think in Europe, in Canada, we've seen all of that happen. Inflation is kind of getting better. You see, if you look at the US reports, inflation is kind of slowing across Africa. If you look on the right side, it's not so good news for Africa. Nigeria, by December, our inflation rate was 29. Today is around about 33 point something. Ghana is now about 22.8 or something like that. So inflation is still, is kind of, is stagnant. It's not going down as fast as it should. GDP growth rate is literally below population growth rate. So you are truly not growing, right? So that's what you find. Interest rate, you know, just taking, the last one is around the FX. So if you look across Africa, Nigeria 100%. So the macro is not, we are still feeling the overhang, you know, from what we're seeing in the global economy. Go to the next slide. Go to the next slide, if you don't mind. So what is the impact of all of that we see? I think the first is inflation is less to cost. Because today we are funding a significantly higher cost than we used to fund before. And it's not even only that, you are not only funding costs, it's also because there's devaluation. If you borrowed $1 million, all right, 2 years ago, and your sources of revenue is cedis, is kwacha, is naira, you are in trouble. Because now the interest cost, not even the principal cost, all right, is going to almost kill you. So really the other is that access. Because the global market itself is slowing down, and the risk of Africa is getting, exacerbated. So we are not even finding that liquidity. You should ask Ghana. Ghana couldn't refinance its bond, and that's what led to what happened. So really, many countries, Zambia struggled, Nigeria struggled, but it's getting better. Kenya went to the market, I think Cote d'Ivoire, we are seeing it, but it's not like what it used to be before. And you see when I show how, in terms of sovereign bond issuance has dropped in Africa over the last 3 years. The third is around, when the dollar is strong, is a problem. Dollar has been strong over the last 2 years. And what it means is that if dollar is strong, why will I put my money here? So there's a lot of flight to quality. Because if I'm going to earn 6% on my dollars on the US, and then I'm going to earn 10% here, that risk premium doesn't compensate me. So I'm going to take my money out. And we saw it in Nigeria, in Ghana, across Africa, where we saw flight to quality. And I think it was also helped by the geopolitical tension, Ukraine, supply chain dislocation, which also led to, shipping costs, went up significantly over the last 2 years. Next slide. All right, so I will speak. Can you go? So I will speak to a couple of things. We do have a structural funding challenge in Africa, clearly. And I think the first thing is, Dr. Janki was speaking to around the capital market. If you look at the first slide, South Africa has the largest, 60% of the market of Africa is in South Africa. But guess what? South Africa is only 12% of the GDP of Africa. You can see how small the other markets are. So how do we leverage this to raise capital? So there are no instruments, all right? We don't have that many instruments, all right? The CP market is not that strong. So access to capital market is a big problem in Africa. And I guess, Agusto and Co. is going to help us solve part of that problem by coming to Ghana. The second is around, I mentioned this before, cost of funding. Clearly, from 4% to 8%, sometimes if you get 9%, honestly, Franklin will be jumping for joy if you get some dollars at 9%. The third is credit risk, credit rating. The international market is all about rating. What is your rating? If you don't have a good rating, you can't raise money. If you want to raise the money, if you want to pay 15%, they will give you the money. So credit rating is so fundamental. And I think if we look at Africa, maybe a few countries, we've seen downgrades all across. So how are we going to raise money? And the thing about this thing is that, so when a country is downgraded, it also affects every entity in that country. So without any, so your own viability rating might be good, but because Ghana has been downgraded, all right, you can't raise money. Or if you're going to raise money because they price you off Ghana, they price you off Nigeria, they price you off Zambia. So it's a structural problem. The last point is around devaluation. So if you look at the last chart, significant Ghana, Nigeria, Zambia, Angola, Mozambique, just name it, Egypt. Significant devaluation across board. So these are the structural problems that we have. If you go to the next slide, if you don't mind. We also have some regulatory issues, constraints, let me call it that. I was telling, I don't know what I was telling, this was like when CBN in Nigeria wanted to increase, that the last increase in capital was in 2004, 2005. I think the exchange rate must have been, what, 180 or something like that. Now, today is now 1,006. Even before then, there has been several devaluations, if you get what I'm trying to say. So What it means is that if there's a devaluation and the banks are carrying foreign currency denominated loans, what it means is that it's going to call for more capital. And once that happens, now, if you want to grow your economy, and that's the problem is the size of the banks, the capital of the banks, determine how far they can push the economy. If they are too small, they can't even fund LNG or Shell or those, they can't do those things because they are too small. For you to push your GDP, you need your banks to be strong. And what you see is, in response to this, a lot of African countries are starting to just say, you know what? Kenya is about to do its own. They're about to go to, I think, $100 million in terms of capital. Nigeria, so we're seeing it across board, and it's going to happen because we do need to have strong banks. The second is around crowding out of private sector. The largest borrowers from the market is government, right? Most economies. 50% of the asset of banks is in government treasury bills or something like that instrument. So how do you support the private sector? How do you get funding to support the private sector? So those are the regulatory constraints that we face. Next. So this is just a sense of the funding landscape for Africa. So if you look, number 1 and 4 speaks to the same thing. So what is happening is that you see, these are the funding agencies. So World Bank, you have bondholders, banks. So this now, from a height of, if you look at 2014, see where we are in 2022. So you can see every year, we've seen a reduction in terms of funding coming to Africa. Now, the next slide speaks to bond issuance. You can also see how low it is in 2022. Now, below the fourth one is really, so what you see is that if all of this is the outflows. So between, the only time you've had an inflow was in 2019, before COVID, and early part of 2023. Every other year, what you've seen is outflow. And that's what I said about, we've seen a lot of capital flight to quality over the last couple of years. Now, the last side is really about pricing. You can see how the pricing, adjust, and it's not just in Africa, but across board, but Africa's pricing. So it's just saying that the funding landscape is that funding has dropped, all right? There's a lot of outflow, and pricing has gone up. So that's what we are saying. All right, next slide. Now, in terms of what is happening in terms of the trends that are impacting, I think I spoke about the first one, which is really the tightened global market financial condition is making it more difficult. The other is around the assistance we used to get. It's somebody that has to give to you. Even if the funders are also struggling, how are they going to give you? So last year was in terms of what has come into Africa. So if you look at countries like Gambia, Sierra Leone, a lot of the effects come through donor agencies, and it's not happening anymore. So we've seen reduced assistance. The third is, and I think this is a very important point, investors are funders are starting to look at ESG. The ESG funding pool, global pool, is $25 trillion. I was actually shocked. That is the money available from an ESG is 25. Do you know how much has come to Africa? Just 5 billion. You can see. Out of 25 trillion, not even 1 trillion. So there is a significant, and it's not going to come if you don't have the framework, the structure, the governance. So there are many things that before you get that funding that you need to put in place. So it's an opportunity. Access Bank has issued quite a number of green bonds. So we are, in terms of this, we've seen this opportunity, and we are not just in Nigeria, we are doing something in Ghana, we're about to do something in Botswana. So all of these things is an important area that people need to. I'm not sure there is any other funding pool that is this big, and it's projected to grow at about 18% every year. So you can see how important this is. Next slide, please. All right. So in terms of how do we react? What do we need to do? And I think Dr. Yankee said around how do we diversify our funding base? Our capital market must work. If you go to Botswana's capital market, the prices remain there day in, day out. It doesn't change. What does that tell you about the market? There is no debt. There is no liquidity. So there are not many, maybe the GSC, even in Nigeria. So I'm saying the capital market needs to work in Africa for us to get some sorts of funding. The second is around partnership. One of the critical sources of Access Bank has been partnership. We are always looking for who to partner with. We are doing something with Afrexim, I think it's public knowledge, where we are working with 13 states in Nigeria to support them to finance infrastructure. It's going to be about $2 billion. We are going to bring 30% and Afrexim bringing 70%. Now, that is a significant, all right, funding that's going to come to support the economy. Now, how many more AFC? There is African Solidarity Fund in UMWA, which is also that. So we need to use those partnerships to be able to generate funding into Africa. The third is around, if your credit is bad, you won't get money. You are not going to get money. So how do we in Africa enhance our credit worthiness? What type of corporate governance do we need to put in place? What type of management structure do we need to put in place to ensure that at least, all right, when Agusto and Co rates you, you get, how long did it take us to get A in Access Bank? 8 years. But we were progressive. We showed them, you know, they were doubters, but they are now believers. You know, so very important, creditworthiness. Anything that you do, we are trying to do something. We are trying to pierce our sovereign ceiling. It's been done before. We've seen it. And that's that. We cannot, because we are not only in Nigeria, we're in 15 African countries. We are in the UK, we're in Dubai, we're in Shanghai, we're in Hong Kong, you know, we're in Paris. Why should we be held by Nigerian credit rating? So we are trying to, you know, ensure that we're able to, so whatever it is, we will get a higher rating than Nigeria, because our business is not a Nigerian business, it's a global business. You know, so very important in terms of creditworthiness. Next slide. So what are we seeing in terms of innovative funding solutions that we've seen in the market, and we think that, you know, it's something that we need to start thinking about. Blended finance, I'm sure most of you know what blended finance is. Essentially, you know, where you have private sector, you know, and DFIs come together, take different risks, and support and support and support. And over the last 10 years, about 152 billion of this funding has come into Africa. So it's not something that is not happening. It's just that not at the level that it needs to be to give us the type of funding we're looking for. I've mentioned green bond and social impact bond. It's amazing how much money they have. Deep pocket. My colleagues are here. They have deep pocket. But before they bring the money out, you actually sweat will come out of your head. So really, you need to do the work, but the money is there, because the reality today is that people are demanding. All right, from a social standpoint, we need to understand what exactly are you doing. How are you ensuring that your processes systems are sustainable? And you are now getting, you're actually getting, if you look at rating agencies now, part of their rating framework, they've introduced ESG into it, just to show you how important. So if you have a strong ESG, it's rating positive for you. I think the last is around securitization. I mean, I can't speak more about this. How do we start to look for, securitization happen here in small bits, but it's not enough to the size of the market that we are in. You know, can somebody do a securitization of $3 billion in one market of mortgages, of some type of assets? So this is one market that truly, if you look at the US, this is part of the problem they had the global financial crisis, because they were doing, you know, securitization upon securitization upon securitization. You don't even know what the initial underlying asset is. You know, so these three things are things that we need to look at. In terms of the conclusion, clearly for me is three things. We have to take our destiny in our own hands as Africans. We have to. Today, all African countries, what do? We take our reserves and go and put in JP Morgan. Right? That's what we do, right? Then we go and raise money and JP Morgan invest in the bond. Do you see it? Why can't we catalyze capital within Africa? Why can't we? Because we can do it. And the longer it takes us, the slower we will grow our economy. And that's what we are trying to lead in Access Bank. That give that money to Access UK. Don't give it to JP Morgan. So that Access UK can come and support. Today, Access UK supports, let me say, almost all Nigerian banks, a lot of other African banks. Now, we have lines of almost $800 million to banks. So we are taking the capital that we have, because it's an African bank, back into Africa. Imagine if those reserves would have what they can. So I'm saying we have to support Africa to grow Africa. We have to believe in Africa. Thank you very much.
Thank you very much, Mr. Kumakwaye, for taking time out and for delivering that beautiful speech. Thank you. Our next speaker this morning is someone that is also quite familiar to the room. He's a member. Our next speaker is Mr. Augustine Simmons. Mr. Augustine Simmons is the head of the Ghana Fixed Income Market. He's a member of the Technical Committee of GIFM and the Market and Products Working Group, managing the Capital Market Master Plan. He has over 23 years of experience across technology and strategy development gained working with the Bank of Ghana, West Africa Monetary Institute, and the Ghana Stock Exchange. He holds an EMBA from University of Ghana, Legon, and a BSc in Computer Science from Kwame Nkrumah University of Science and Technology. Please welcome Mr. Augustine Simmons.
So my story is very short, a very short one. When Dr. Yankee has spoken and the executive director has spoken, mine should be just an appendage to what they have done. I've been tasked to talk about the state of the debt capital market in Ghana. As Dr. Yankee said, the debt market was established in 2015. What was our objective in setting up the market? We wanted to set up the market as an addition to the equity market to redirect distribution of funds and financing from the sovereign to the real sector of the economy, so that we will see production GDP increase, because the real sector would produce an impact on the GDP and then increase employment, increase revenues and income in people's pockets, and so that we increase welfare in the economy. So this was our objective. As well, we wanted to bring transparency, price discovery, and visibility of the institutions that come onto the market, so that they are seen worldwide. Have we achieved this? What have the market done over the years? For the past 8-9 years, we've been able to trade almost to 1 trillion Ghana cedis on the market. And as I speak now, government issuance, the size of the market, government issuance in the market is about above 300 billion Ghana cedis on the market. And the corporate, unfortunately, as I speak now, is just about 9.8 billion on the market. So though we have brought about transparency, price discovery, liquidity on the market, the other objectives have not been achieved, and that's what we all have to work on. Yesterday at the ACI conference, we've all seen what we can do to increase production and increase the real sector of the economy activities, and so that we all have to work on the interest rate, we have to work on our forex so that we have a better economic environment. So what is the state in addition to all of these figures that we are talking about? What are the things that we have to look at? The thing is not working. So let's go to the next step. So it's not working. All right, so let's go to the next step, the next slide. So this slide is telling us the environment within which the debt market is operating now. I think the first two speakers have really talked about that, and the situation. Okay, the situation is not different from Ghana. In the midst of the GDP that has been on the market, we have, as of December 2023, 76.3 billion USD, and the growth in this year, the second quarter, is just about 2.8%. Inflation, the July figure is showing 20.9%. Don't talk about the exchange rate. I was just looking at from 2022, early 2022, our rate was just around 4 cedis for a dollar. And now look at what we are. On the Bank of Ghana website, we have 15.1315. That is the weighted average. And we are also affected by external shocks, as we can talk about what is happening on the geopolitical activities, talk about Ukraine-Russian war, talk about Hamas-Israel war. All of these are within the space in which the market is dealing now. The last 10 years, we've seen a lot on our Ghanaian environment. We've had a banking sector clean up in 2018. Just as when we were resting from that, we then have the COVID in 2020. The COVID just eased up, and then we have the Russian-Ukraine war came in. And then, as if that is not enough, we were visited with the DDEP. All of these have effects on the Ghanaian debt market, the environment within which we are operating. So there are a lot of challenges that we need to deal with to make this market that efficient as we want it to be. So you could imagine there's sort of environment that the market is in now. What's the state now? So the ripple effect on the debt market, coupled with the banking cleanup, COVID, and the DDP. I was just sharing with my colleagues, those on the technical committee and Franklin, when you have the monetary policy rate at 29, and then you have the interest rates on the markets around 24, where is the connection? So we seem to have a challenge. There's some mismatch. We need to sync that. We need to bring these two and ensure that we match the two so that we see the impact on the market. At the Ghana Stock Exchange or the Ghana Fixed Income Market, we've worked hard to ensure that we have a robust regulatory environment. So our rules that guides the markets is constantly reviewed to ensure that it matches up to the dictates of the time, the trends as on the market. We've been able to establish the CP market. We have put in place regulation to guide the issuance and the admission, listing, and trading of the green bond market. Not too long, the SEC has also issued the guidelines with regards to green bonds in the country and guiding us with the taxonomy for issuance of green bond, what product qualify to be issued and financed with green bonds. And so all of these are available. So I'm happy the executive director, when he was talking, he talked about a lot of funding that are waiting to be issued. We are ready. I want to assure him that the market is ready for that. So Access Bank, please channel all those investments onto the market. And I'm happy to hear that you are issuing a lot of green financing. Please come and list them on the Ghana Fixed Income Market. So that's a challenge that we are throwing to you. And then we have indeed a nascent corporate bond market that we are struggling to develop. And this is where we want to appeal to the banks that want you to bring your customers to the market. You cannot give 5-year loan to a customer, but the market is ready to give financing 5 years and above. All right, and already we have companies that have come to issue those some of these corporate and on the market, and it could interest you the rates that they got. Casapraco came onto the market and issued not too long ago, and he got a rate lower than the sovereign. All right, Eastway and Bayport have done, and they all gotten rates that is lower than what the government is getting on the market. So it means that the market is really ready to look at whatever company you are bringing onto the market, if the figures are right. And fortunately now we have rating agencies in the country too, domestic rating agencies, which we don't have to depend on the S&P and Fitch and so forth. So that will also cut down the cost of rating on the market. And I want to be assured that your charges will not really disadvantage or be a huge cost on the issuers who are coming onto the market. So on our market, for the commercial paper issuance, any potential issuer who is coming to issue on the market, we have made it a requirement that the entity should be rated before. Why do we need that? So that we have a third-party view of the issuer who is coming to the market. What is the profile of that company? Are they having any hidden debt somewhere? So the third-party view done by the rating agencies to bring out all about the company. The company would have told its own story in the prospectus, but we need another view from a third party to advise the investors, so that investors can really make an informed decision, a better decision based on information that is available, and so that this issue about asymmetry of information on the markets can be resolved, so that we have better information on the market to advise our. So we have been able to do that. Even on the equity side, we have also working on a private market, so that not only do we want to help companies come onto the public to issue debt, but we also want to build a private market where we have venture capital and some angel investors can indeed place their investment into companies. So we really are ready to help companies come onto the market to raise money to build up their companies. Please, let us be like the other markets where they start business, then their next target is to come onto the capital market to raise money. That is where the market, that is where you have to come for capital. That's why we call it capital market. The banks can only lead you to a certain point, but you need to have a better capital to expand and grow your businesses. You need to come to the capital market, and the market is available. There's so much, over 60 billion Ghana cedis that is waiting with the pension funds, where they are looking for avenues to place this investment, and our companies are keeping to themselves. Ghanaian companies are keeping the companies to their chest. They don't want to open up. Please, the rating companies will help you open up, do transparent business operation, transparent financial reporting. I'm happy you have our colleague from the UI there to help you really put up your information and prepare yourself to come to the market to raise funding. And the Ghana Stock Exchange is ready for that. The Ghana Fixed Income is ready for that. And we have all the environment created for you to come onto the market. In the midst of this, we have the challenges that the FS is also posing to us. The cedi depreciation, including the active black market in the system. And all of these have to be dealt with. I was just sharing with the ACI colleagues here that I think we should, as a country, sit at a conference and all we should talk about is interest rates and FX issues. And we need to do that. And we have to be deliberate to bring down interest rates in the country. If a company goes for a bank loan and it's almost about 40%, how do you do business with that cost already? So in 2 years, the money you went for, you are paying that same money to the one who gave you the money. How do you grow? You're just working for the person who gave you the loan. So we need to discuss these issues on our market and bring down the interest rate to ensure that it will really impact on the real economy. People can raise money and do business and grow the economy. And this is what I'm taxing the ACI people with Ghana Fixed Income. We collaborate with them to have a conference on interest rates in the country. I think we can do that and see what can we do to bring down the rates down. Whilst in the African environment, in the African countries, yes, we seem to have almost the same economic issues, but their rates are lower. I'm sure Kenya is not doing 30%, or no. Nigeria, with all these challenges, they are not doing that much. Why we are always at that height? Why? What's wrong with us? We need to talk about it and bring the rates down. And I'm very passionate about that. And this is something that we have to work on. So this is the environment within which the debt market is, and we're really struggling to make things work. What are the challenges? We have limited education, financial education, and we championing that with our stakeholders, especially the youth and schools and colleges. We have the youth network, investor network, right? And for the past year or two, we have been able to deal with about 20,000 students coming onto that program to be educated. We have also working with the Institute of Financial Economic Journalists, and so that through them we can have our message being sent out. We have regulators in silo, and that creates regulatory gaps in the country. NIC has its own, MPRA, Bank of Ghana, SEC. And so sometimes it becomes an issue who then regulates some of the product that we have on the market. But we are happy to say that we have the Financial Stability Council that has been set up so that they meet regularly to discuss some of these issues that happen on the market. And we hope that it will lead to a situation where we have, like in the UK, where we have the financial board that deals with issues about regulation. Our biggest challenge is the unstable economic environment. When can we solve that? When can we have that stability? We seem to move forward and then we move backward. That issue have to be dealt with because that's a very unfriendly environment for capital market, and we want to we ensure that we deal with that. What are the opportunities for us? Like I already said, we have the green financing opportunities set up with all the regulations available. So an improved regulatory environment. It will interest you to know that Ghana now is counted as by the ICMA, International Capital Market Association, their legal opinion. We have a positive in terms of all the Global Master Repurchase Agreement, the clauses in there, all the rules and agreements are enforceable in our country. So you should not be afraid to go into any transaction when it comes to, especially on the repo market. When you give facility to an entity under the Global Master Repurchase Agreement and there is default, you go to court, all the rules in the agreement are enforceable under that. And so Ghana is the third country in Africa that has done that, besides South.
to start by thanking everybody. Specifically, I'd like to start by thanking Dr. Yankee for coming to support us and for giving the keynote address. We do not take it lightly at all, sir. I would also like to thank Mr. Simons, the head of Fixed Income Market, for also coming this Friday morning. I think we're learning that Friday is not the best time to have a conference in Accra. Thank you so much. And a professional who has left to rush back to Nigeria, Sheyi Kumakpayi. I've known him for 20 years professionally, from rating of Access Bank over the years. So I'd also like to thank all of you for coming in, the news people as well. Thank you so much for coming to spend time with us this morning. I would really like to start by saying that I totally agree with what Sheyi Kumakpayi has said, which is that nobody can develop Africa aside from Africans. And the bulk of the money that we're looking for is actually in the African continent. And you'll find out that more and more, and I'll try and bring a lot of context into what I'm going to talk about, that companies are now beginning to realize that the funding that you go and get outside exposes you to foreign currency risk. And some of the very big gains you make over the years, you can lose it in one sweep by the devaluation of the currency by the government. So, for instance, I'll give an example, MTN Nigeria. If you look at the figures of 2023, huge FCY, foreign currency loss, and it was just because of a loan that they took from the foreign market. And what are they now doing to be able to reposition themselves? They're issuing bonds in the domestic market. They're issuing a lot of CPs. So from being very market shy in Nigeria, all of a sudden they're coming to the CP market with different issuances because that insulates you from foreign currency risk. And they're not the only ones. Even a subsidiary of Heineken, Nigerian Breweries, significantly owned by Heineken, I think about 50-something%. Also last year, if you look at their figures, huge foreign currency losses, and they're now coming to the market to raise local domestic money from the debt market in Nigeria. So companies are beginning to realize that, a lot of the foreign currency loans, initially it looks cheaper because you can pay sometimes 8%, 9%, but just one depreciation of the domestic currency and all those gains are eroded. So I just want to talk this morning to talk about the inverse relationship between credit ratings and the development of the debt market in terms of looking at the rates, the yields on bonds, and then try and bring in life lessons, what we've experienced in Nigeria, what we've experienced in Kenya, to be able to put context to it. So my presentation is really going to first talk about, well, what are credit ratings, why are they important, the development of the debt market, what is the relationship between credit ratings and the debt market, the case studies I talked about, and a bit about Agusto and Co. So what are credit ratings? And I just wanted to bring the definition of United Nations Economic Commission before I speak about in a layman's way. It says credit ratings provide an essential measure of relative credit risk, facilitating the efficient issuance and purchase of bonds and other debt instruments. For African governments and corporations, credit ratings are pivotal in determining borrowing cost. And so when you find out that based on your rating, you're able to determine the yield on a bond, depending on, of course, market conditions, track record, the tenor of the bond, and etc. But remarkably, and we all agree in this room, that Africa is going through the same thing. In Nigeria, we have an FX crisis. In Kenya, we have a fiscal debt concern. In Zambia and Ghana, fiscal debt default. And what does that mean? It means that the macro risk in African countries have increased significantly. And therefore, it also means that as interest rates are high in the US, a lot of investors, international investors, are beginning to drop African bonds because the risk is way higher. And so that is also a critical part, and being able to access international markets is also a problem for African sovereign entities and even African countries. So what does that now mean? With this increased risk, investors are now looking for greater transparency, higher disclosure, and improved corporate governance. And that's where the credit rating agencies come in. They're like a third party in the whole scenario. They're not on the buy side, they're not on the sell side. They're just an independent body coming to speak on the ability of that company to fulfill its obligation. And because they have gone through a robust system whereby they ask you to disclose from things such as governance, to your business strategy, to even your accounts, understanding why it is, getting your auditors to sign off that to the best of their knowledge, the accounts that they've given for the credit ratings is true and fair and is a perfect reflection of that organization. So they bring about transparency, they bring about disclosure. And when companies realize that to gain access to the capital market, you need to disclose more, it helps the market eventually, because the market becomes more developed, more transparent, and investors are comfortable coming to invest in the debt insurance of those companies. So what are we saying? I said the introduction of credit ratings in Nigeria marked a significant milestone in the country's financial landscape. And I just wanted to talk a bit. So Agusto & Co. commenced in 1992. And from 1992 to 1998, they were issuing what was known as public information ratings, because the market did not believe in ratings. So they really brought about the concept of ratings into the Nigerian context. And what happened is, as those ratings were being issued, the banks couldn't be bothered about it. But what happened to the market? The banks that Agusto & Co. had classified as high-risk banks started to show signs of distress. Some of them became, in fact, went into bankruptcy. And then the market now started to say, look, this company has been issuing these ratings, publicizing it, we didn't look at it. But from what we can see, the banks that have been declared high-risk institutions in terms of rating category were the ones that exhibited weaknesses in terms of their financial condition, and in some cases were declared bankrupt by the Apex Bank. And so the market started to recognize what we were doing. And it was on the basis of that in 2001, which is 9 years after operations, that the Securities and Exchange Commission licensed Agusto & Co. And so it was when that culture developed extensively, and I'll be candid with you, it wasn't until 2005, 2006 that the foreign rating agencies now came into Nigeria to rate banks. Because then they had seen that there was a ratings culture, there was transparency, and because of that it was easier for them to come in. And of course, in addition to that, the Nigerian banks were now going to get listed on the London Stock Exchange. And so the big three needed to reach them to come and to be listed. So, but the truth is, there was a ratings culture. There's a domestic market. And just to collaborate what Mr. Simons has said, there's a 60 billion Ghanaian cedis pension asset that all they're doing is putting it in government securities when they can give it to non-sovereign corporates to develop their business and to in turn develop the market. So that is very critical to mention. So in 2024, the Securities and Exchange Commission in Ghana issued a new set of guidelines on credit ratings, and we were licensed in 2023 December, and we became the second rating agency operating in Ghana. So in simple words, what are really credit ratings? It's really looking at the creditworthiness of an institution and its ability to meet its obligation. So we can issue two types of rating. We have what is called the entity rating, and we have what is known as a debt instrument rating. The entity rating is just looking at you irrespective of any obligation. It's not specific to an obligation, it's just looking at you and say, what is your creditworthiness? You know, it does not take not specific to any particular debt, does not take into consideration the specific nature or even any regulation, but just saying, what is your ability to meet your various obligations? And that is an entity rating. Then we have an issue rating, and the issue rating is looking at a particular debt issuance by an entity and saying, what is your ability to pay back on this debt obligation? So we can issue either an entity rating, which is more, or we can issue a debt-specific rating. And what is a ratings? You were saying a rating is one. It's not an audit. So Samuel from EY will tell you, for you to do a rating, we need the audited accounts. So an auditor must have done some work. So our rating is always on the back of the audit. So where it's not an audit, it's on the back of the audit. Also, it's not a recommendation to purchase, sell, or hold any financial obligation. It's just an independent party giving an opinion on a particular transaction. It's also, It's not an equity opinion. So when we look at ratings, we do not tell you if an equity price of a company will go up or go down. No. It's to look at a particular debt instrument and to say what is the ability to fulfill their obligation on this particular debt. So it's an objective assessment of the financial condition of an obligor and his ability to meet his obligation as and when due. And these ratings now have different categories, which I will talk about next. But typically, what do we do in Agusto and Co? When we're looking at a rating, we have a top-down approach. And what does that mean? It means that first we understand the macro environment, how the macro environment impacts on the industry, and then in turn, the various entities in that industry. So one of the things we've done, and we'll be talking about at the end of the day, is to release a Ghanaian banking industry report. And that we have done. We've worked on it and it will be released at the end of today in this session. And what does that really do? It looks at the whole industry, how the macro environment has affected the performance of the industry, how it has affected capital, how it has affected liquidity, how it has affected cost of operation. So we always say to ourselves that you cannot rate a particular entity without understanding the macro and without understanding the industry they operate in. So I'll give an example. If you look at the banking industry, there are two segments in Nigeria and all over sub-Saharan Africa. You have the microfinance banks, you have the commercial big name banks. Now, even though they operate in the same industry, the risk in the microfinance banks is always higher than that of the commercial banks. And typically, because of that, their capital tends to be weaker compared to the big commercial banks, and their credit risk in terms of impairment levels tends to be way higher compared to the big commercial banks. So we look at it and say, in assigning ratings, we look at it and say, how does the industry play regarding to this? So our rating approach is top-down. We look at the macro analysis, the industry analysis, the company analysis, then we score, and then it goes to rating committee. So for instance, for financial institutions, and I will not delve in, I just want to quickly touch because I'm also mindful of time. One of the things we look at it, when you're looking at the quantitative analysis, for instance, for a bank or a financial institution, we look at your capital adequacy, asset quality, profitability, liquidity and ability to generate funding, staff productivity, market share. Our belief is this, and it's been tested in all markets. The bigger a bank is in terms of market share, the more regulatory support it will get. So if there's any bank in Ghana, for instance, that controls, I won't mention the bank, that controls a significant amount of market share, then if that bank for any reason has financial difficulty, the APEC bank will bail them out. Why? Because too big to fail, the strategically important element of that financial institution. So things like that are things that we look at. What is your market share? Are you relevant to the economy? And if you fail, will the regulator be willing to support you? And then we look at qualitative analysis, things such as ownership structure, which really ties down to governance. And that's where in Africa you see a bit of the owners of banks, sometimes, or companies, do not want to disclose their market share, their ownership number of shares, but we'll delve into it. And you must disclose it, and you must sign our letter of engagement. So ownership structure, strength of internal processes, we look at your risk management framework, your treasury framework, we look at your asset quality framework, your operational risk, the market risk is all encompassing. We look at technology. We even look at things such as how you react if there's an adverse news about your company. Is that something like that? Do you monitor that, the impact it has on your business? So we look at risk management, procedures for monitoring compliance, quality of management and staff, environmental and social impact. It's very critical as well. For manufacturing companies, we look at profitability, operating cash flow, financing structure and adequacy of working capital, leverage, and then also the same thing in terms of qualitative issues, industry risk, entity share of the market, quality and diversity of ownership, corporate governance, stability of key personnel, staff productivity, quality and timeliness of financial reporting. So those are the kind of factors that we look at in qualitative issues. So why are credit ratings quite important? And what are the benefits? One, we always say to companies that it's actually a cheap means of obtaining consulting advice, because we look at you and tell you this is where your problem is. And it's a cheap way of, without you getting the big consultants to come and charge you an arm and a leg. We also say it highlights your strengths and your weaknesses of any corporation. It looks at, it provides an independent assessment of corporate performance. And so it can be used internally to address your issues, it can be used externally. It's also a basis of comparative performance among peers and helps with financing at a risk-reflective price, while also creating a benchmark for price recovery. So that is a major thing, especially in the fixed income market. So what do you understand? Why is it important? One, risk assessment. Two, pricing of your debt instrument. Three, it brings about investors' confidence in that entity, market credibility, and most importantly, it provides you access to finance. And these are our credit scale. And I wanted to share also that if you think about Agusto and Co, we're 32 years. The bulk of the ratings that we've done in Nigeria, in Kenya, has been national ratings. And those ratings are really done to try and say, what is your risk rating when we compare you to other issuers in your particular country. And that national rating gives you access to funding from the pensions. Whatever money is available, insurance companies, whatever money is available in the local debt market, you have access to it. We also issue what is known as a global scale rating. And we've done that for multilateral agencies like the AFC, the BOI, multilateral agencies, and that's a global scale rating that is comparable to what you would see with the Fitch and Moody's when they issue a rating and they put a sovereign ceiling. But we've done that mostly for the multilateral agencies, whereas the bulk of our ratings have been national. And our ratings really is looking at AAA to BBB is investment grade, and BB to D, or even to C, is speculative, and D, you're in default. So predominantly, we put the modifiers so that you can see relative comparative standing in each rating bucket. And so we have the rating from AAA all the way to BBB minus as investment grade, and then we have the BB plus to C as speculative and D in default. So the investment rate represents a high likelihood of fulfilling your obligations. And so we have what is known as the rating migration matrix, which we've tracked over the years. And it's very, very unusual to find a AAA rated company go into default. We haven't had that experience at all. So we have a ratings migration schedule that shows to what extent have ratings in very high category of investment grade, to what extent have they gone into speculative over the years of last 32 years. And we have that indicator that we use. But speculative is high likelihood of default, assigned to businesses with relatively high risk of default, also referred to as junk instrument. But one of the things we say in rating agencies is that it's better to have a speculative grade rating than to have no rating at all. Because what it means is that when you have a speculative grade, your investors can price you accordingly. It doesn't mean that they won't touch you. And we've had many BB rated entities access funding in Nigeria. So it's not a do or die thing is what I would call it. It doesn't mean because you're BB you can't get access to funding. No, you can get access to funding. It just means that the investor will price you accordingly. The market will price you accordingly to reflect the degree of risk that you carry. And so we also have outlook, positive, stable, negative, that we allocate to ratings to say that if it's positive, there are things happening in the market or in that company that can lead to an upgrade in a near term. If it's stable, we don't expect our rating to change in the near term. And when we say near term, 12 to 15 months. In negative, that means there's something happening in that industry that can lead to that particular entity's rating being downgraded. So we put that to kind of warn the investors, so that investors see that and say, oh, that means there's something to watch out for. So the debt market, I would not talk about the definition. It's a market where fixed income are issued and traded by investors. And in the market, sorry, I just wanted to say, in the market you can have normal bonds, and you can also have commercial papers. corporate bonds, and green bonds. And I just wanted to talk a bit about green bonds. He was talking about the ESG having about 35 trillion available funding, and Africa has only been able to tap 5 billion in Africa. I remember Access Bank was the first bank to issue a green bond in Nigeria, and that was in 2019. And they raised over 15 billion. I think by the exchange rate at that time, maybe what, equivalent of $10 million. And it was used for shoreline protection. So if you've been to Lagos, you know that we always have threats of the ocean eroding into the city. And so that fund was used for shoreline protection and other kind of green assets that need protection. Now, what is good about that is that companies are beginning to come to raise green finance because it's way cheaper. And also a lot of institutional investors want to put money into what they perceive to be protection of the climate. So it's a significant area. We've also had a company, an hydro company, power company, North-South Power, also issue a green bond to be able to do hydropower in Nigeria. So green bonds are the next future. In Kenya, for instance, where we do, I'll talk about what we do, that because we're also accredited by Climate Bonds Initiative to do what is known as green projects verification. So we're the first African indigenous company that has been accredited to do that by the Climate Bonds Initiative. And we've done a lot of second-party opinions, green assessment. In Kenya, for instance, one of the things we did is to assess 10 counties in Kenya to say, what green assets do these counties have that can be refinanced internationally? And we did that. And the UK government invested significantly, I don't have the exact figure, but significantly into it, and that was done last year. And we did the assessment. So we also do green bond assessments to check, are these assets really compliant with the taxonomy of Climate Bond Initiative? And then we're accredited by ICMA as well, the Global Capital Market Authority, to issue green bonds and to rate them and also to verify them. So what's the relationship between credit ratings and the debt market? And I just wanted to put a bit. I said it plays a crucial role in determining the cost of funding. And what does that mean? A BB-rated entity cannot come and raise money at the same interest rate as a AAA. It shouldn't be. The market should penalize you. Why? There's a higher degree of risk. And that company can deteriorate faster than a AAA-rated company. So you look at an example, an MTN, for instance, AA plus rated, national rating. They raised money at 12.75. A Presco, AA rating, a bit lower than MTN, came in and raised money at 12.85. Somebody would ask, you know, but the rating differentiates them. If you look at Dangote Limited, 13.5, A plus, they raised money at 13.5. If you look at Flour Mills, A minus, 14.5. If you look at SKLD Integrated Services, 16.62. So the rating differentiates the pricing that you raise in the debt market. And that is why it's very important, because every entity should not come into the market and raise money at the same interest rate. The risk you carry is important in differentiating the pricing. So we always say that there's an inverse relationship. When the higher a bond's rating, the lower the interest rate, because you get money cheaper. If your rating is good, then you get money cheaper. The lower a bond's rating, the higher the interest rate. So there's an inverse relationship between credit ratings and the bond yields. So when we look at the market, we say that it plays a very important factor in determining the pricing. Very, very important. Now somebody can ask, if I look at a rating maybe 3 years, the same rating, and yet one company is able to get money cheaper. Sometimes it has to do with the market condition. Sometimes it has to do with track record. Sometimes it has to do with bond structure. So if a bond is longer dated, then the interest rate you pay on that bond will be higher. Why? The longer dated a bond is, the higher the risk of default. In terms of when you look at it, it can go into default in 10 years. So that is also priced into it. So you can have the same kind of rating, and somebody will get funding maybe 50 basis points higher. And then you ask yourself why. Sometimes it has to do with track record. You've never come to the debt market before. They don't know how well you will do. That's your first time. The market will penalize you. Also, it has to do with industry dynamics. If they feel that your industry is not as strong as maybe another industry that is issuing at the same time, it will also have a part. So, but the critical thing is the credit rating is what investors use to differentiate the pricing. And it's a critical tool. So, and one of the things the credit rating also helps you do is it helps you elongate your funding. I was having a conversation with Mr. Simons at the beginning of class, and I was saying to him that we had a subsidiary of Tolaram Group who have a free trade zone, not Lekki Free Trade Zone. And they raised money for 25 years, fixed rate. And that takes away a lot of subjectivity because you can plan. 25 years funding. Banks, no bank can give you 25 years funding. So the debt market cannot be ignored. For the development of any market, you need the debt market because that is where you're able to get access to longer dated funding at an assured interest rate without you getting a letter from the bank saying, due to Bank of Ghana increasing interest rates, we hereby jack up your interest rate to this. You don't have that story when you're in the debt market because you've locked in, you've locked in. So looking at case study, I just wanted to mention a few. That if you look at Kenyan Mortgage Refinance Company, they raised money. Also Easeway, I think Mr. Simons mentioned Easeway. Easeway also raised money in Kenya. They issued a 1.7 billion Kenyan shilling bond that we rated, and it was subscribed. Also in Nigeria, one of the things we say is that we have a deep debt market. We have the value of the NGX, which is the Nigerian exchange, and the FMDQ, the fixed income market, where as of 2022 stood at about 54.2 billion. And I would say that as of today is about $94 billion. Of that, 30% of that, or about 32%, equivalent of $32 billion is raised by corporates, non-sovereign entities. And another 10 billion is raised by the states. So we call them subnationals in their own capacity. So it helps deepen the market and it reduces FCY risk. So I just wanted to talk about the corporate issuance in 2022 to 2023, and I just brought in ABC Transport, the major transport company that bring people with luxurious bus from Lagos to Accra. They came and issued a bond, fully subscribed, 16.5, triple B rating. Dangote Cement, A+, 11.85. They raised money as well. Dangote Cement, different tranches. Dangote Industry, Flour Mills of Nigeria, the biggest flour miller company in Nigeria, they raised about 46 billion naira, A- 14.5, fixed rate. Lagos State, which is a subnational, they came in their own capacity, raised 115 billion naira from the debt market in their own capacity, no enhancement by the central government in their own capacity. The Lagos Free Trade Zone, talked about, 13.25. There's no bank that was going to lock them in 13.25 for that length of time. So this is just examples of corporate bonds that were issued in 2022, 2023. And this is just talking about something even Cheyi also mentioned. If you look at the debt market, South Africa's debt market is about $225 billion. Nigeria, I used the 2022, today is about 54 billion. Kenya, 20.54. And the largest issuers in this market are in Nigeria and in Kenya is corporate, government. So we need to grow the market and diversify it. So my conclusion, I said a credit rating will help evaluate the creditworthiness of a corporation, municipal or subnational, or even a sovereign. And as the African economy grows and financial markets mature, the role of credit ratings will become more important. Critically, in Ghana, credit ratings will be critical to creating new growth spots in the capital market, as credit ratings can help unlock the potentials of the country's debt market, thus stimulating capital into the Ghanaian market. It is clear you need, the money is internal. So let's use it to develop the economy. And I think one of the problems we have is the pricing, and the credit rating solves that. Another problem we have is when ratings are deteriorating, it allows investors to know that there's a credit deterioration in that particular issue, and then they really reposition. One, you can sell your debt, or even call for a meeting and say, we notice your ratings are coming down. We need to look at things. You can diverse different things. So the ratings also helps that, to monitor your investment, and that's also very critical. So just to talk about Agusto & Co. Since 1992, we've been in existence. And 2023, we were registered as a credit rating agency in Ghana. In 2013, 10 years earlier, we were registered as a credit rating agency in Kenya and in Rwanda, and we operate there as well. In 2022, we were certified as an approved verifier, which I had mentioned, by the Climate Bond Standard Board to perform verification of green bonds and projects and assets in Africa. We have issued over 3,500 ratings to date, and it continues. So this is where we're located, and we're located in Ghana, Accra Atlantic Towers, and we opened up in April there. In Kenya, we're in Westland, Nairobi, for those who go to Nairobi. Rwanda, we're in Avenue du Commerce, and we do credit ratings, we do customized research. Remember I talked about the banking industry report that we're also going to talk about at the end of class. We've also released customized report. We have over 50 sectors that we track. 50 in Nigeria, about 6 in Kenya, and in Ghana, the first sector we're tracking, or we've tracked, is the Ghanaian banking industry, and the report is up for subscription, it's available for subscription. So we do industry research, we do green bond verification. Thank you very much. Questions? Before I call on my colleague, Ayokole. So the next step Ayokole is coming to do is to showcase some what we call public assessment of some banks, and to give them a public rating. So he will come and talk about that. But any questions, please? Or would you like to take the questions after Ayokole? Okay, so after Ayokole. Thank you very much.
Okay, thank you very much, Mr. Adelekun. And like she mentioned earlier, when we started in Nigeria, we started by doing what we call the public information risk assessment, right? In which we assess companies based on available public information. So we've done same thing for the banks, for some of the top banks in Ghana. But before even going to that, I think it would be appropriate to first talk about what public information risk assessment is, right? So I'll talk about what public information risk assessment is. I'll talk a bit about the factors that we use in the assessment, and then I'll show you the results of the assessment of some of the banks that we've actually used in this exercise. So, public information risk assessment is just looking at the financial strength of an entity, okay? Looking at the ability to meet obligation as and when due. Now, there is a slight difference between public information risk assessment and credit rating. Although at times we use the same criteria, but there's very subtle but very important difference, which is for the public information risk assessment, what we've used are only available public information. Everything's available in the public domain. However, for us to do a proper credit rating, you need to sit down with the company. You need to understand the company in total, understand their strengths, their weaknesses, their strategies, where they are going to. And honestly, it can be a bit grilling. You could hear Sheyi jokingly mentioning about it. Some of the session at times can be, meeting with the management can be a whole day at times, right? Particularly if it's the first time rating. But assessments, we are only focusing on informations that are available publicly. So what we've done is to, like I said, if you assess a few banks here in Ghana. And to enable us carry out these assessments, and in line with our top-down approach, what we've done is to first look at the banking industry, to understand the dynamics, understand the strengths, the weaknesses, the regulatory environments, the challenges that the industry is actually facing, right? Mr. Adelekun will be coming later on to talk more about the Ghanaian banking industry report, which is a report that we actually even collated after that exercise. About 120 pages report, so for you to know how comprehensive that particular report is. So for this public information risk assessment, we've looked at qualitative and quantitative factors, right? The qualitative factors are things that we can look at objectively, things like capital, looking at the sustainability of profitability, liquidity, and some other factors. Then for the qualitative factor, we look at things like ownership, the support that the shareholders can actually even give to the company, right? The strength of IT, all those ones, we've looked at it in that particular assessment. Now, in looking at the public information risk assessments, we also look at the short-term expectation for that particular bank, which is what we call the outlook. And that outlook can broadly be three: either positive, things are expected to get better; stable, it will be business as usual; or when we think it's actually negative, things are going south. So having done that, we've conducted the exercise, and the outputs are communicated using a using three scales, right? You can either be in the low risk bucket, medium risk bucket, or high risk bucket. For those in the low risk buckets are those that are significantly financially strong. Those are entities that even when there are storms, right, if you can call that, regulatory storms, macro storms, there will only be a slight increase in the risk profile of such banks. For those that have medium risk, although they are strong, but there might be some shaking when the storm comes. But the thing about it is that some of them have very strong shareholders that are willing to back them up. And for those in the high risk buckets, those are the ones that there are some or two issues with those banks. And if there is actually any storm, right, they will need external support to them to actually start firm. So this is the outcome of the exercise that we've done. What we've done is to look at about 9 banks, right? You agree with me, these are some of the biggest banks that we have around here. And out of those 9 banks, 3 were assessed to be low risk. We have 5 that are in the medium risk bucket, and then we have 1 in the high risk bucket, right? But please note, like I said earlier, this exercise was conducted using only publicly available financial information. And the truth is that if we are to conduct a rating exercise, the output might be different, right? So please, let's have at the back of our mind. This is just to give us an idea about that also. So I think I will bring up our group managing director, Mr. Adelekon, to talk about the Ghanaian banking industry report. Thank you.
Please, any questions before? I think our colleague is dodging. Any questions? Yes.
I had interest in the last slide you showed, but I can't see my bank there, so I'm just wondering.
Okay.
Is it that we don't qualify to be in this category, or we are above board?
No. Yes. Okay.
Good morning and thank you very much. My name is Damola. I'm from EDC Nigeria. My question is this: how often do you review the rating you may have done for some issuances? I recall there was a situation in Nigeria back in 2018 when I think the Lagos State government set up an SPV for the waste management collection process, right? And it went bad in a way, and I think Agusto had rated that issue at the time, but the downgrade came after the risk had crystallized. So I want to confirm, how often do you, I mean, it's my opinion, you might want to correct that, please.
Yes, I want to correct it.
Yeah, so I mean, how often do you do this review to ensure that you're able to advise the market accordingly?
Okay, so when we're engaged to do a rating, one of the important factors in the letter of engagement is that every quarter we would have a rating review, meaning that the entity will give us their quarterly account, we'll rescore, we'll have meetings. That is very important. So one of the things different from our rating and a lot of other ratings is that our rating maturity period always is 12 to 15 months. And that's because we know that the degree of risk in Africa is way higher. So you find out that some rating agencies will say their rating is long dated. We don't give long-dated ratings. And at every point in our report, we'll write there's a maturity date so that the market sees it. That once that rating has lapsed, if we are not engaged to do the rating again, we will suspend the rating. And that's very important because of the vulnerability in the African market. So that's one. Secondly, just to answer the one you talked about, that was a rating, that was a bond guaranteed by a subnational. And it was a test of our framework. And which is why I say local knowledge, local experience. The subnational had a change in governor. And at the point in time, the new governor was reluctant to take on the obligation of his predecessor. And then we now corrected him and said that's not how it works. The minute you default on this particular instrument, that subnational has defaulted in the debt market. You would never be able to issue a debt instrument easily in that same market again. And the minute the people, the political people realized what the implication was, they came and they fulfilled the obligation. So it never crystallized, it never defaulted. They paid till it matured. So what does the credit rating do? In every market in Africa, there's a tendency when there's a political change for a new governor or whoever it is to say, I'm not going to fulfill that obligation. But that is where the market steps in. That is where the rating agency steps in to say, if you do that, you have defaulted. You cannot now come and issue another instrument. A default has occurred. Your reputation has now been affected. The market will now not come and accept another debt instrument you want to issue, because then the credit risk is no longer the same. So to address your question, they did not default. There was conversation to not fulfill the obligation, but the market brought them back and said, you have to, because once you default on that, subsequent transactions will be looked at, you've defaulted. So that's what the market does. The difference between when you go and raise money from a bank is that a bank or a company can say to the bank, I'm not paying, call the CEO of the bank or the board. If it's the debt market, the debt market is owned by you and I, all of us, our pension. Therefore, you cannot say you would not pay. The minute you do not pay, a default has occurred. You are blackballed in the market. That is the difference with the debt market compared to that of a bank. I hope I answered. They paid. They paid. That money was paid. Take it from me. If they didn't pay, they won't be in the market issue.
No, eventually they actually did the payout. But there was a maturity at the time. I think we're supposed to be paying interest twice a year. I think there was an interest that was due. And
so the interest was due. The document says 10 days, but you also have a lapse. You have a grace period of 30 days, and they paid in the 30 days.
Yeah, eventually.
Yeah. Okay. Not eventually, within that grace period of 30 days. If you had gone past that 30 days, it would have been a default.
Okay, thank you very much. But I would expect that, as a rating agency, you would have seen all of these nuances as, they were coming up, and you'd have advised the market accordingly. Because, a lot of investors will be relying on your reports, in determining, what level of investments they will have in those, with those issuers, and when to pull out,
Yes.
as the case.
Let me also explain to you that that particular nuance you're talking about is something that wasn't expected. Nobody could have expected it. Why? The party remained in government. That party did not change. All the change was the person. The party did not change. So you would expect that that party would immediately fulfill its obligation. What we did not expect was that there was going to be an individual clash. But let's put that aside. The fact is, did they fulfill their obligation? Yes. There will be different nuances. And let me give you an example. When state government wanted to start to issue ratings, we were called by the Debt Management Office. My late founder was still alive, and they said, we want states to, subnationals, to issue ratings without credit enhancement from the central government. And we said, okay, the only way around it is ISPOs, which is an irrevocable payment, standing payment order, which is, we all know that the states, the only way to get them to be fiscal discipline is to take the money from source, even before it gets to them. And so that ISPO has helped that no state has defaulted today. Meaning that from the minute that the central government wants to share statutory allocation to you, even before it goes into your account, it goes to the trustees who now pay the bond, the debt instrument. That came about by dialogue to say, look, how do we ensure that we mitigate the risk as much as possible? And that's why sometimes when entities come and meet us for ratings, especially for bond instrument, and then they're saying, we look at it and they say, this is junk. They say, okay, what can I do to enhance my rating? We say, go and get a credit rating from a company or an entity that has a better rating than you do. Which is why, when Sheyi was talking about them going into other markets, it's because they didn't want to be seen as a Nigerian bank, go to other markets with higher credit ratings, and therefore help their own credit rating eventually. So what are we saying? You can come, we'll tell you you're junk. If you say, well, the market has said no, then we'll say, go and look for credit enhancement. And that credit enhancement also protects the investors. Do you want to add anything else? Okay, so it's not only me answering the questions.
I think it's also important that we mention the impact of the credit guarantee companies in Nigerian markets today. We've seen that their impact has been able to also help improve the overall rating of some of the issuances that has to do with infrastructure development and all of that in Nigeria. And maybe you might want to also talk about that here, and also how the Ghanaian market can also collaborate with such credit guarantee companies as well for credit enhancements as it is.
Okay, thank you. So we have a company known as InfraCredit. It was set up by a company known as Garanco in partnership with the UK government. And what they've done is to come in and set up and we call it a multilateral agency because it's owned by AFC, African Finance Corporation, it's owned by NSIA, Nigerian Sovereign Investment Authority, it's owned by Infraco Africa, and then it has a callable capital from Garanco. Now, what they've done remarkably well is to issue guarantees to infrastructure projects. Infrastructure projects on their own have a lot of issues that investors don't want to deal with. Projects run off time, fulfillment of obligations. And what has InfraCredit done? InfraCredit comes and guarantee that company will meet its obligation, any company that is providing infrastructure for service. And in return, they pay InfraCredit a fee. So InfraCredit is like an insurance company. They pay them a fee for that guarantee. And interestingly, because InfraCredit has been paid a fee for that guarantee, InfraCredit ensures that they do a lot of due diligence on that particular company that they're underwriting, do a lot of restructuring of their governance, of their business, and guarantee that company. So in what has happened is that particular entity that has the guarantee of InfraCredit is able to come to the debt market and issue a rating at AAA because InfraCredit is rated AAA. So two things happen. The credit risk is minimal because they're guaranteed by InfraCredit. Two, the pricing of that bond instrument is the same pricing at a AAA rated entity. So on their own, they probably would have had a higher level of pricing on their bonds. Instead, what they have is a lower yield on their bond because it's guaranteed by InfraCredit. And so that has helped unlock a lot of transactions. For instance, just to address what you said, the Lekki Free Trade Zone that I talked about, owned by the Solaram Group, was also guaranteed by InfraCredit. So it's helping unlock a lot of funding for infrastructure in the debt market. So that's also a tool, a way that Ghana can go.
Yeah.
Thank you.
I was wondering whether you're getting into the ESG space.
Yes, so we do verification of ESG projects.
And help companies to try and attain those? Yes,
to comply with the taxonomy and to say that they're verified for green assets. Yes, we do that. That's also very important as well. Because it's a huge amount of funding available that I personally believe that companies in Africa can access. And I think, interestingly, we did a second-party opinion on a company known as Bond Manufacturing. I think they have some business in Ghana, and it was done by the Kenyan office, but it was clean cooking gas. And they raised $10 million from the Climate Fund to be able to to lower their cost and to access the ESG funding. Yes.
Hello, my name is Omar from Ghana Stock Exchange. My question is, I'm sure you've heard it several times as a presentation, but I'd like to satisfy my curiosity. How does Agusto maintain its independence from the rated companies?
Well, no, so it's not that it's only my voice.
Okay, so first and foremost, we have a robust rating methodology. So it starts with the people and then the company as a whole. So as at Agusto & Co., we hired the right people. But beyond that, we have a framework that ensures our independence. And I'll explain some of those nuances within that framework that ensures our independence. For instance, we separate the business from the analysis. So commercials are dealt with largely by a different team, and then the business of the rating is done by the analyst. So it sort of removes financials from the determination of the rating outcome. Once commercials are done, we then proceed with the rating. Our ratings are reviewed by multiple teams, and then that is culminated with a rating committee. So in terms of the rating process, once you've gone through, so we come to you, you engage us, we come to you, we understand your business, we have meetings, we go back to our office, put the report together. That report is first reviewed by a team lead. Subsequent to that, all rating reports at Agusto & Co. are reviewed by the managing director for quality assurance. After that, we send back to the client for their comments, input. Once we get that feedback, we then send to a rating committee. That rating committee is made up of unique members that are not all within Agusto & Co. In fact, 2 out of 5 of them work with Agusto, and the other 3 are external. They are professionals in their own right and have deep knowledge of the local economy, of the financial markets, and the macroeconomy at large. And then we get their inputs independently. For a rating to be assigned to a company, you must have at least 4 out of those 5 rating committee members concur, and they are concurring independently. So even the managing director of Agusto & Co. cannot determine the rating outcome. So those are some of the things that we have in place to ensure that we remain independent. And beyond that, what we do sell as a business is our reputation and independence. So that's, if you compromise that, then you don't have a business essentially. So it's something that we hold very highly, and it's something that we implement across everything that we do in the rating process. I don't know if that provides some.
Just to also say what, to add to what Wonu have said, and I've heard this question many times. I always say to myself, we're no different from the auditors. The auditors look at the figures, they audit, they're professionals. We are professionals. If somebody asks, which is what Wonu is saying, what is the largest asset on our statement of financial position? It's our reputation. You lose your reputation, you lose your business. The minute people realize that you're compromised, then you've lost your weight. And I always say this, and I hear even the foreign companies come and say, to operate 32 years, to come out of Nigeria is not easy, and to maintain our professionalism. And it's because of our rating committees, because of the processes that we put, that not one person can issue a rating. An analyst cannot sit down and be bought by a client. And the rating members of rating committee, many times, we don't try to divulge them so that somebody cannot say they want to go and meet them and lobby. No. We try as much as possible to keep them away from the business. And they're just giving their candid opinion. And many of them are professionals, top professionals in their career. Some retired. Yes.
Hello. Yes. So Ghana has a unique economic and financial landscape, right? We had some banking crisis somewhere in 2018. We've just gone through a domestic debt exchange. How do you plan to adapt your robust methodologies to our unique circumstances while ensuring reliability and transparency at the same time?
Thank you very much for your question. And yes, you are right, Ghana has gone through its fair share of economic turmoil. But not different from Nigeria, really. Everything that's going on in Ghana, my colleague would always say, we've gone through it multiple times in Nigeria. And we are rating in Nigeria. So we understand, so, outside of that, again, and which is one of the things that we've spoken about very significantly at this at this conference today. Our ratings aren't just ratings. Beyond being a rating agency, we're a foremost research house. So research is the backbone of what we do. So what that means is that before we can even rate any company, any fund, any asset management company, the first thing is you have to understand the economy and then the industry. In speaking of the Ghanaian economy, even though we haven't been here, it's an economy that we've tracked for over 20 years. We've conducted trainings, consulting engagements within Ghana. So Ghana is a country that we are very familiar with. We tracked the entire process of the DDEP. We've done, this year alone, at least 3 consulting engagements for different companies within Ghana. So we understand the macroeconomic environment. And we've worked within a more volatile macroeconomic environment, if I may say so. So we understand the nuances, and sometimes that's the perspective that we do bring, the local advantage. We are Africans for Africa. So we come from a place of information. So research, like I say, is the backbone of everything that we do. So we do a lot of macroeconomic research, and as part of this event, we are launching a banking industry report. Again, a lot of research went into that. So while this is even the first publicly available banking industry report, we've also tracked the banking industry for many years. So we've worked with many banks in Ghana, even though they weren't ratings. So we've worked with them, we understand the landscape, and that's why we're able to produce a report. And it's on the basis of that that we'll then go ahead to provide opinions of the institutions. So I think we are well equipped to be able to do that.
The next one will answer the question.
Yeah, thank you so much for your answer. So you realize that the second part of my question, I was also focused on how reliable that would be. One of the key things that you seek to achieve is how comparable your rating is. So if I'm an investor and I'm looking at Ghana, I'm looking at Nigeria, I'm looking at maybe Ivory Coast or another country, because you are contextualizing your rating in Ghana, how do I compare that to that of another country?
Okay.
To make an informed decision.
Okay. So that rating that we're issuing to you is a national rating. Now, if you want to do a rating that you want to compare cross-border, then it will be a global scale rating. So the national rating is to compare you to entities in Ghana, in that particular region. If you want the one that you can compare country to country, then that's a cross-border rating and is a global rating scale. Okay.
Thank you, Ayekunle. My name is Lachu. I work with the First Round Group, so FMB and RMB. And I think just to address some of the concerns from the GSC and from a colleague in the other bank, in Nigeria, right, I've had different experience with Agusto, and this is not just pitching for Agusto, but just talking from experience. Before moving to investment banking in 2019, I used to work in a asset management, the largest pension fund in Nigeria. And as an investor, we always relied on Agusto's reports to make our investment decisions, right? Because they had built that reputation of independence and giving you third-party information about making your investment decisions. And then when I transited to investment banking, now as a financial advisor, advising corporate banks coming to the market, I think over time working with them, you read because of their methodology, earlier on one of the presentations, different ratings have different expectations, both quantitative and qualitative. So even just looking at the financials of the company and the qualitative, you have a sense of where that rating will be before you even go into the exercise. And most times they don't deviate from it. And one thing also, sometimes we fight because we have different views, but we fight. And then one thing we appreciate about Agusto is that when we fight, their basis is based on certain principles, right? So it has really helped our market, and I'm happy that the GSE has introduced credit ratings into the commercial paper market. It will help in pricing securities adequately, because based on the credit rating, right, you can then have a sense of how much risk the company is. So it's a good initiative, and I'm sure as this progresses with time, you would see the value add that they bring and other rating agencies bring into your market to chip that in.
Thank you, Laju. And on a lighter note, just to, if you remember what Sheyi Kumapa, he said, the Executive Director, Access Bank on African subsidiaries, he said for 20 years, and truly I've known Sheyi for 20 years, on the rating, not that, before that I worked in a bank. And for 8 years, the rating didn't change. They wanted a higher rating, and I said, look, you still need to do things the way we want you to do things. We've looked at capital, we've looked at asset quality, we've looked at liquidity. These are the areas you need to address to move your rating. It took them, what, about 7, 8 years before the rating could move. So many times we don't have friends. That's the truth. Rating agencies, we don't have friends, because people want you to give the rating that they want. But we don't give you the rating that we want. We give you the rating that we believe that you are. And so that is what it is, and that's what has helped us over the years. Keeping to our methodology, sticking to it, and many times we have fights. When we go to meetings, I can't tell you many stories. In fact, I've had one of the biggest banks, the MD walked out of the meeting. I thought the man was going to pick a call, and then somebody just said he has left. I said, was he that angry? They said yes. But 2 years after the bank MD was gone and the bank CBN took over on leadership. So we say it the way it is. And we always tell you that that's the way it is, following our methodology. Okay. Thank you very much, ladies and gentlemen. I think the next part is really to talk about our banking industry. And so, because we've talked about our top-down approach, we're releasing a Ghana banking industry report. The report's outline is overview of the Ghanaian macroeconomic environment, structure of the banking industry, financial condition, which is looking at all the players. We've added all the banks together in terms of their statement of financial condition, in terms of income statement. We've done all that. We've done a financial condition. In that financial condition, there's an assessment of the asset quality, assessment of the capital. So you see some banks have need to raise capital in the near term. It's there identified in the report. We've also put in ranking of various players, so you can see the market share of each of the key banks, what market share they control, the regulatory environment, the new regulations and how it will impact the banking sector, industry trends, that SWOT analysis, ranking based on total assets, profitability ratio, capitalization ratios, deposit liability market share, among others. We've done that. And then we've rated the industry as a whole. And that's also to determine the kind of credit quality that the industry has. Then there's outlook and the summary and forecast. We've forecasted the banking industry as well. That is available for subscription, and it's on, if you go into www.agustogh.com, you have access to subscribe to it. And please, we look forward to your subscription. Thank you. Thank you very much. So without much ado, I think we call for Prince to come and give our vote of thanks. Thank you very much. And thank you everyone for spending your morning with us. But vote of thanks.
Right, so thank you very much. On behalf of Agusto and Co., I would like to first off thank our speakers for educating us on this very important subject matter. And then I would also like to thank all of you for coming through, making time out of your busy schedules to come and then attend to the invitation that we gave out. So thank you all very much, and we wish you the best of the rest of the day. Thank you.
Please, we would like to give a small gift to our keynote speaker, Dr. Yankee. Please. Well, thank you so much, sir, for spending your morning with us. We appreciate it. We'd also like to give something to Mr. Agusto. Thank you very much.